We'll be doing a few back tests on Verizon this episode with 20 years worth of backtesting transaction data. There's a demo version of this backtester online now. It's at this URL linked in the description. Check it out and give it a try. The demo only has data from 2003, but it's real data and fun to play with. If you find anything interesting in that data, good or bad, post comments here and let us know. Last episode, there was a request in the comments for a Verizon backtest of selling calls, duration around 4 months, and delta around 0.3. So let's do that. This is my local environment with the full set of data, currently around 20 years, from April 2002 through May of 2022. We'll run this test from January 1st, 2003 to December 31st, 2021. As requested, we'll set the duration to around 4 months, or 110 days to 130 days, and we'll set the delta to around 0.3, 0.25 to 0.35. Let's set the minimum volume and open interest to 1,000 so we don't include any lightly traded options that might have big spreads. Let's ignore everything else for now, and we'll come back for more in a bit. Forgot to set the symbol, Verizon. Let's take a look at the results. The first option it found started March 18th, 2003. The last one started June 18th, 2021, and the last expiration was October 15th, 2021. It only found 88 options for Verizon over the 18 years meeting the criteria. 60 of the 88 were out of the money and 28 were in the money. The percentage in the money was very close to what Delta predicted, 32% to 30%. Average duration was very close to our 4 months, 121. Average volume was just over 2,000, and average open interest was just over 18,000. Recall that we set the minimums to 1,000 for each. The worst option lost $663. The best one made about $198, and the average was a profit of about $27 for a total gain of $2,353. These numbers only count the results of the call options. The goal of this backtest is to measure how selling call options affect your overall returns. The return on this backtest does not consider gains or losses on the underlying stock or dividends. Now let's look at the chart and see if we can make sense of the backtest visually. The blue line is the price of Verizon over this time period, from 2003 through 2021. The green lines, here and here and here, are options that finished out of the money. The seller profited by the full amount of the premium collected. The red lines, here and here and here, are options that finished in the money by an amount more than the premium collected. So the seller lost money on these red options. The yellow lines are options that finished in the money, here and here and here and here, but the seller still made a profit. The amount in the money was less than the premium collected, but the shares would have been called away if held through expiration. Option sellers were making money from 2003 all the way through 2009 here. This backtest was up over $1,000 at that point. Then Verizon stock made a big upward movement. You can see sellers went from 1,000 up all the way to 1,500 down here from mid-2009 through 2013. Then from 2013 through 2021, call sellers using this criteria in this backtest mostly did great, going from 1,000 down, going from 1,500 down to almost 2,500 up. What can we take away from this backtest? It's a very small sample using criteria to restrict the results to only 88 options over 18 years. So it proves nothing, but is still interesting. Luck plays a large role with such a small sample size. If an option just happens to exist during a big upswing, then it is obviously going to hurt the results. It looks to me like this criteria may have been a little lucky for call sellers because it seems to have missed a lot of the up spikes, like here and here and here, and here. This test reinforces my belief that when you think a good stock is severely undervalued, like maybe down here, consider not selling calls. Or if you do, be very conservative with low deltas and be ready to roll when a big up movement like this occurs. Let's do one more VZ backtest to show off some additional features of the backtester. We'll modify the criteria to shorten the backtest date range and find more options to get a denser pattern. I've already entered the criteria: Verizon, 2019 through 2021, 25 to 35 duration, 100 min vol and open interest, and a delta of 0.1 to 0.3. Let's run it. Found 803 options meeting this criteria. The percentage in the money, 13, was less than what Delta predicted, 20%, which means call sellers probably made a nice profit on their calls over this period, but the underlying stock probably didn't do so well. The average call over this time period made almost 20 bucks. Let's take a look at the chart. So Verizon was bumpy, but mostly down over this period. Here's the pandemic bottom. Luckily for call sellers, not many calls were sold meeting the criteria close to the bottom here. Just a couple. Otherwise, it's probably about what you'd expect. Some brief losing periods here and here and here and here and here and here during up spikes, and some nice long stretches of winning calls while Verizon was mostly falling. Let's see if we can smooth out or normalize the results a little. Some individual days have a few different option contracts that meet the criteria, so these heavy volume days could skew the results, and we may not want that. One thing we can do for this problem is to sum the results of all options in a single day and average the results down to 1. That's what this feature does: condensed day. Let's see how many it finds when we condense individual days, so a day will have at most one option. Previously, we had 803 options. Now it only finds 492. The percent in the money was 1308. Now it's only 11.79%. So apparently some bad days had a dense volume of options. Restricting it to one option per day looks like it's going to help option sellers. The average option previously made $19.70. Now it makes $20.48. Let's take a quick peek at the chart. The chart looks very similar, but there's only 492 options instead of 803. There will only be one option line starting from each individual day now. Really not a lot to say here other than the results are a little better when condensing to one day for call sellers. It proves nothing, can't really draw any conclusions other than for this particular backtest, losing options seem to come packed into single days a little more often. Might be something to look into to see if this is true in general. One last feature I wanted to show is just looking at winning or losing options to see if they have any interesting attributes. Let's go back and just take a closer look at the ones that lost over this period. Maybe we can find something that might be helpful to avoid selling calls on Verizon that are more likely to lose. That's what this radio button does. We can run a backtest and tell it to only bring back the losing options. So let's check out the losers. We'll go right to the chart. It found 68 losers, and each call option lost an average of $68. If a call seller was astronomically unlucky and sold one option on each of these bad days, she would have lost $4,649. Question: do you see anything about this chart that would help a call seller avoid times when selling calls is a bad idea? That would be here and here, 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 here. I'm not a chartist, but if someone sees something in technical analysis correlating the losing options with chart patterns, I'd love to hear about it. My thought is to go back and look at the fundamentals of Verizon and current events at the start of these big clusters of losing options. See if anything sticks out after looking at these things and consider not selling calls on Verizon during similar circumstances in the future. We could dig through the enormous amount of option transaction data and play with these different parameters, looking for insights and patterns that might be helpful in the future when selling options. We could set different values for stock symbol, date range, duration, delta, volume, open interest. In the future, additional filters like implied volatility, gamma, and theta will be available. Please leave comments if you found anything interesting in this episode or if you find anything in the demo with the 2003 dataset. All stocks with options on major exchanges back in 2003 are available in the demo, linked in the description. That's it. Thanks for watching until the end. Please consider liking and subscribing if you enjoyed the content, and have a profitable day.